as well, is that we need Canada's business community to step up and be much more vocal and active in terms of influencing politicians and policymakers on what needs to happen so that you can get investment in, you can hire people, continue to expand your businesses. So in the Q&A, we can talk about some of the things that are going on in that regard that we're already seeing throughout the country. But now what I'd like to do is introduce Jack Mintz. Now, Jack is going to be on the screen. Jack was supposed to be here standing at this podium. He was in Calgary yesterday, and he took him, I think he had 4 postponements of his plane flight, because what happened in Toronto, it rained heavily on all that snow that's there all day long, like monsoon type rain. And then finally when it stopped, all of a sudden, within a half an hour, the fog came in, especially around the airport. And I was staying at the airport, and we were talking on the phone, and I said, Jack, I can't even see across the street now. And so it really delayed all the flights. He ended up getting into Toronto, I think around 2:30 in the morning. So he apologizes. He's at home in Toronto, but he's definitely going to give you his full presentation. And I think we've been able to arrange it so we will have a good Q&A. So let me introduce Jack. Before that, I should introduce Stuart. Stuart Meyer is the founder of Resource Works, which is based in Vancouver and advocates for responsible resource development across Canada. Forestry, mining, and energy are its main focus. And he's also a host of a new series he has called Power Struggle, a podcast about energy and resources. So Stuart, thanks for being here with me today. And Stuart and I will take the place of Jack and I in the Q&A, and we'll have Jack involved in that, and we sure hope we get lots of questions from him. So Jack, Dr. Jack Mintz is a President's Fellow of the School of Public Policy at the University of Calgary. And after serving as a Palmer Chair from 2008 to 2015, he's currently Chair of Alberta Advanced Education Panel on Post-Secondary Education Funding, and also on Alberta's competitiveness. He's a board member of Mackenzie Health, York Region, Ontario, Canada West Foundation, and the Aristotle Foundation for Public Policy. Dr. Mintz is a distinguished senior fellow with Don Laurier Institute, senior fellow at the T.D. Howe Institute, and research fellow at International Tax and Investment Center in Washington. Also a fellow with the CSIFO, which is a German think tank, and Oxford Center of Business Taxation. He's a weekly contributor to the Financial Post of Canada, and his op-eds appear not only in Financial Post, but in other papers throughout the country, like the Mail, but also in the US and internationally. I was asking Jack today how many op-eds he's done, and he's estimating that it's over 400. And so he's very widely read, and he's a well-respected commentator on tax and fiscal policy in particular. And he also has over 250 publications in his name. So with that, as an introduction, we're looking forward to his comments, and we're looking forward to the Q&A after. Welcome, Jack.
Thank you. I hope everyone can hear me.
Yes.
Okay, and I assume my PowerPoint is up on the screen, and you can see that as well.
Yes.
Good. Okay. Thank you very much, Jerry, for your kind introduction. And I am very sorry that I can't be with you today. Unfortunately, the weather gods weren't in my favor, but at least technology allows a different option that is at least better than fully canceling out. So I'm very glad to have this opportunity to give you a presentation really on the issues that I think are facing the Canadian economy. Some of these have been well before talking about Trump tariffs, but I think the Trump tariffs have now exposed, I think, a bigger problem that we're going to have to deal with. So what I want to say are really a few points, and maybe this will be sufficient for some of you, and you might want to sleep through the rest of the presentation. But I think you might find some of the discussion quite intriguing. Before Trump tariffs, we already knew that we have had a poor economic performance this past 10 years. And as I'll show you, we know that we've had stagnating growth in per capita GDP. Our investment has been very poor, and these things have certainly have impacted the Canadian economy. Now, I argued in an article that Canada is not really broken. In fact, I think there's a lot of great things about our country, and I can be very upbeat about a number of them, and then perhaps we'll conclude with a few things at the end. But I do think that we have been badly managed over the past decade, and I think these are some of the things that are going to be needed to be corrected, I think, if we're going to do better. Now, we haven't been able, particularly in the past decade, to leverage, I think, our most important comparative advantage, and that's the resource sector. And I think we fail to take recognition about how important resources are to Canada. Historically, it's been always true ever since the fur trade, going back in our early days as a country. But we also have had mining, and we've had forestry in those days. And today, of course, we have a lot of resources in agriculture, fishing, forestry, mining, oil and gas, etc. But they have been what I'm going to show you has been a very significant part of our comparative advantage. A little while ago, in preparing a paper with Phil Cross that was published by the Macdonald-Laurier Institute, I looked at the website of the federal government that talked about Canada's advantages, and there were a number of them. I think they were fair to state, but what I was shocked is that there was not one word about the resource sector, and the resource sector really is our most important comparative advantage, which I'll be able to show you later on. The Trump tariffs, which I'm going to talk about at the end, exposes even more our weaknesses in the economy and the corrections that are going to be needed. And I'm overall, and this will be my message, is that if I think that Canada can make itself clear that it's open for business, we can take advantage of that, of the resources, not just all the physical resources we have, but also the human capital that we have as a country that we've built up over the years, that we can really prosper for many years to come. Now, let me begin with really some points just to make clear about why things have stagnated so badly. Going back to 2015, you can see that the United States has had relatively good growth. Of course, lately they're having a few challenges that they brought in as a result of their tariffs. But as you can see, it has done quite well. Of course, everybody got hurt by the pandemic in 2020, but you can see that the U.S. has grown while we have completely stagnated over the period since 2020. In fact, our GDP per capita is hardly changed at all since 2019. In fact, it's even lower now. And I think, as you can see, the United States is actually growing, whether we're talking about the original Trump first term or the Biden years, where there was good growth as well. The United States certainly has benefited from particularly the huge technology companies that have developed there. Sadly, now, the United States is actually GDP per capita is almost 50% more than Canada. A third more than Canada, and I think that's this is the biggest gap that we've had for quite some time, and that puts enormous pressures on us, in particular where people may feel they have a better opportunity to live in the United States in terms of doing business and earning income. In fact, migration to the United States has picked up over the past few years. Just some new numbers came out last week that is showing that 2024 was again another year of a significant increase of Canadians moving to the United States. Those are the kinds of pressures that happens when you start falling behind. And obviously that's something that we're going to need need to be corrected. This is a graph just to give you an idea that the problems we've had with investment really goes back to originally the big commodity bust that came at the end of 2014. And so I didn't update this diagram. It was something I did a couple of years ago with a colleague, Phil Bizel. But you can see that Canada, which is the orange line, it's in gross capital. This is business gross fixed capital formation. Back in 2011, it was roughly 11% of GDP. By the time 2014 came, which was the height of the commodity prices, or at least relatively good commodity prices, it moved up to 13% of GDP. And now we've fallen below 10% of GDP, roughly about 10% of GDP by 2020, or before 2020, actually. But I think what's more important is the fact that we have dropped so much relative to everyone else, including OECD countries, which generally are their capital formation has been above 12% of GDP. You can see United States has slowly risen. The 2017 Tax Cuts and Jobs Act, with a much lower corporate income tax rate in the United States, started having some positive impact before the pandemic. But you can also see that Norway, which is the red line, resource-based economy, oil and gas is very dominant in terms of what it does. But they didn't behave like Canada. In fact, they have much more investment than we do as a share of GDP. And despite the commodity bust, which did affect them in 2015, they've come back up where their investment is about 14% of GDP. That sort of tells you that even commodity-based economies have done well. Australia has dropped tremendously, mainly because the mining industry has took a real hit from the reduction in commodity prices, although it has improved recently. Now, I think this is another story that I think is very important, and that is how governments, and here this is the G7 countries, how they've done in terms of per capita GDP and their growth, but also how we do in distribution. And so I provide here something called the Gini coefficient that economists estimate in terms of inequality. Just to give you, I won't go into all the intricacies of the Gini coefficient, but basically, if the Gini coefficient is 0, everybody has the same per capita income. It's perfect equality in society. And if the Gini coefficient is equal to 1, that means one person, let's say Elon Musk, has all the money in the world and everybody else has nothing. So that the Gini coefficient of 1 means it's the most extreme form of inequality. And you can see that in the case of per capita GDP in 2023, and these are measured in what's called international dollars by the World Bank, Canada is really no different than many of the other G7 countries. It is higher than Japan. It has been historically, and Germany has been higher than us historically as well, but we're now tied. But I think what's more important is the cumulative growth in per capita GDP over this period. And you can see that from 2015 to 2023, it has been, in Canada, it's been close to 0. This is cumulative. That means 2% over 8-9 years. That's very little in terms of growth. And in fact, as we know, 2024 was a bad year. So basically, we've had 0 growth in per capita GDP. Now, Europe has not exactly been stellar. The pandemic obviously had an impact, but they're not doing that great. Although surprisingly, Italy is actually doing better than I would have expected. But their cumulative increase is roughly about 6%, including Japan. And when you look at the United States, of course, it has grown much faster than the other G7 countries at 15%. And there are countries that have even grown faster than the United States, particularly Ireland, which I'll mention later on. Now, we've done really poorly in terms of growth, but in terms of redistribution of income in society, we've actually done very well. So the pre-tax Gini coefficient, what that means is that's basically market income. And the post-tax is income minus taxes, but adding in government transfers. It does not include the value of in-kind government transfers like free healthcare and free education. As you can see in Canada, we don't have as much market inequality as other G7 countries. It's 0.44, which is a smaller Gini coefficient than the other G7 countries. And we do quite a bit of redistribution. In fact, we reduce our inequality by almost 28% to 0.29, which is the lowest post-tax Gini coefficient of all the countries. We're very close to France and very close to Germany. They're just slightly above us. But you can see the United States as everybody else has more inequality than Canada. I think what I really want to say with this particular graph is that Canada has especially the last 10 years, we've undertaken a lot of policies to redistribute income, and we have been successful in redistributing income and reducing inequality in society, but we have not had very much growth. And in fact, I think that's been a problem in our public policies over the past decade, is that it's not been sufficiently focused on growth. Instead, it has been really all about redistribution, which I think has been a very significant problem, and one in which we have to get back on track, not necessarily to undo redistribution, but we certainly must do more in terms of getting more growth in our economy. Now, you may wonder really what the top exports that Canada has, and of course this will get into later discussion a few things about tariffs. And in this chart here, what we provide is the really three things of interest. One is labor productivity in different sectors, of the top exporting sectors of our economy. And this is labor productivity is, of course, very important, because the more productivity you have, the more output per unit of working hours, then not only can you pay for wages that people get, but you also get more taxes, and you get more other returns to capital, et cetera. And of course, more capital-intensive industries tend to have higher labor productivity. And in fact, machines and buildings and intangibles, those are the things that actually add to what people can get in the end. And it's no surprise that when you look at crude oil and natural gas, it actually has the highest labor productivity of all sectors in the economy, except, as you can see, refined petroleum. But I can tell you, if I broke down crude oil and natural gas and just had oil and gas extraction in the oil sands, it's actually close to $1,000, and actually higher than even refined petroleum. But the main point here is that if you actually look at wages, you'll see that the industries that tend to have the higher labor productivity also tend to have higher wages paid to their workers, and that's certainly true in oil and natural gas, which is one of the best paying industries in Canada. The average is only $63.50 across all industries, but you can see all our export industries, certainly except for auto parts and lumber, tend to have very high labor productivity. But it's also, I think, one of the reasons why we've had such a bad decade in terms of economic growth, is that we've had policies that have tried to stultify the growth of some of our significant resource sectors, and as a result, we're not getting the kind of growth that we need. You can also see that the sectors that are really most important in terms of, we'll talk about trade later on, is clearly crude oil, natural gas, and if you include refined petroleum, as well as those particular sectors, you can see that that's a very significant share of our exports that we sell to the rest of the country. In fact, to the rest of the world. Sorry, crude oil and natural gas and refined petroleum, as well as they make up almost 20% of our exports. You can see iron and aluminum are very important, as well as fishing and lumber. What's interesting is that except for auto parts and autos, which are very important, they are almost 12%, a little bit over 12% of our exports to the rest of the world. But the rest, and pharmaceuticals as well, but the rest, as you can see, are very much resource based. And so this goes back to the fact that our big comparative advantage has always come from the resource sector, but it also has been a significant contributor to our labor productivity and to our GDP per capita because of the strength of those sectors. Now, some of you might be interested, especially thinking in Thunder Bay, where mining and forestry are obviously extremely important sectors of the economy. In the case of natural resources, you can see natural resources that we broadly define to include not just oil and gas and cutting trees and finding and pulling fish out of the water. Not only do we include that, but we also include the other resource sectors that are very closely tied to the resource sector themselves. That would include things like refined petroleum, petrochemicals, wood, pulp and paper, lumber, etc. All the things, even all the manufacturing sectors that you think of the economy that are also tied to the resource sector. And as you can see, total natural resources make up almost 15% of Canada's GDP, and of course, energy is a very important part of that, almost half of that as well. And that has been historically true. And of course, when you have the fall off in commodity prices, there was a dip down in terms of their importance as a share of GDP, but of course, they still remain very important to the Canadian economy. Also, these sectors are very important in terms of business investment. Investment in the natural resource sector at one time was over half of business investment in Canada. It's now around 45%. But what's kind of interesting about this diagram is that despite the commodity fall in commodity prices after 2014, investment is still very important in the natural resource sector. It still makes up almost 45% of total investment in Canada. So if we don't have a strong natural resource sector, then obviously we're going to have weaknesses in our Canadian economy. And if we don't make sure we get the best that we can out of those resources, then we won't do as well in that sense as well. Now, we also know that natural resources are critical to our trade balances. In fact, really the trade surplus we have with the United States right now, which is roughly about $100 billion in Canadian dollars, is primarily due to our natural resource sector. In fact, all of it is due to the natural resource sector. In fact, once you take away natural resources, really, when it comes to everything else, Canada has pretty well just a zero trade balance in those sectors. And so that's why I think natural resources have been really important, because it's also not only given us a greater wealth in terms of exporting our goods and services to other parts of the world, but it's allowed us to have a higher dollar. Take away those natural resources and you'll get a collapse in the Canadian dollar, because our net exports would drop dramatically, and that would have to be made up by a lower Canadian dollar as a result. So, and of course, when you have a smaller Canadian dollar, that means our per capita GDP in, let's say, international dollars is much lower, and that means Canadians are earning less income compared to other places in the world, and of course that puts pressure on people wanting to leave Canada to go elsewhere where they can make more money, as opposed to staying in Canada, where if you have a very low dollar, incomes and salaries are certainly not as good as what you can get elsewhere. Now, I think before I turn to a few other things, I think we have to remember that there are many things that affect investment One of them, of course, is taxation, which I'll say a few things about in a moment. But investment depends on really what's the demand for our products, and of course that will depend on not just domestic demand but international demand. It will also depend on the cost competitiveness of our industries in terms of how productive they are, and that's why when you don't have a lot of investment, your unit costs are going to be higher and you'll be less competitive internationally. But also, if you have regulations that impact your investment, slow things down, and as we know, Canada has, by international studies, has done poorly in terms of the time taken to get permits, and the time taken to complete contracts. There's been several dimensions that have been looked at. There are areas that actually we do quite poorly, actually, relative to other OECD countries. And of course, that has been a significant problem, including what we've done to our oil, gas, and mining industries, where we've put in a regulatory system associated with Bill C-69, which is tremendously complex and has slowed down the approval of projects. And so it's not just in the oil and gas, where we know we're not getting pipelines built, and except for the Trans Mountain pipeline that finally got built and added 0.25 percentage points to our GDP, but also we haven't had other ones built, and for that reason we tend to have an oil and gas sector that is primarily tied to the U.S., where over 90% of our oil and gas is sold to the United States. But the mining industry has also not been altogether successful in getting projects done. Major mining investments have not been done for quite a while, and there has been quite significant problems in achieving that. One area where we've had some good success, besides political stability, by the way, which is also important compared to many other countries, Canada has had relatively good stability, especially after we've taken care of some of the issues that we had with Quebec, at least in the past. But we've also had, because of tax reforms, corporate tax reforms, since the year 2000, where we lowered rates and broadened bases, we have, and adopting the value-added tax that we did in 1991, we have allowed our, at least from a tax point of view, our industries to be more competitive. So, for example, today, this is called the marginal effective tax rate. This is the amount of taxes paid as a share of the return on capital on the last dollars of investment. That's what determines people will invest in capital until the return is until they've exhausted any profitability from that. And so that's why the marginal investment is very important to analyze how taxes can affect investment decisions. But if you look at Canada, where and this is including not just the corporate income tax and all the aspects of the corporate tax base, but also issues like sales taxes on capital inputs, like the retail sales taxes in BC and Saskatchewan and Manitoba. It also includes any capital taxes, transaction taxes like real estate, transfer taxes. All these things we include in our analysis. But you can see that the aggregate effective tax rate is about 17% in Canada. But as you see, often pointed out, is that we have a system very biased towards manufacturing, and that's why forestry has a very low effective tax rate, because of the manufacturing incentives for pulp and paper and lumber mills. But we also have much higher taxes when it comes to the service sector. And the current level in the United States, by the way, is around 24 or 25%. So we're much more competitive on the tax side compared to the United States. And a large part of the U.S. Competitiveness problem actually has to do with the retail sales taxes in the United States that adds 4 or 5 points onto their effective tax rate. However, if you notice here, Canadian oil and gas actually is the most heavily taxed sector because of the combination of the various taxes, including the royalties that are paid on investments. Mining actually does very well. It's actually one of the favored industries when it comes to taxation. And we've done a lot of work internationally on mining taxation for the Inter-American Development Bank. There's a very long paper that we've written on that that came out last year. But actually, Canada has one of the most tax competitive competitive systems for mining investments in the world. So the problem in mining investment is not due to taxation, but is very much due to regulation that has really stultified investments in the mining sector. So these are kind of issues that we have to think about. The fact that we have a lot of distortions in our tax system favoring some industries and hurting others more. And also we have regulatory issues that I think are pretty important and have to be dealt with if we really and truly want to see more investment. And then along came Trump tariffs. And as this is obviously the big topic these days, and it's very serious. I originally, just 2 days ago, CS IFO, which is the IFO Institute in Germany, put out a very short paper, but it's really based on a very complex model that they have of the world to evaluate trade policies around the world. In fact, it includes 141 countries and 68 economic sectors in each country, and it's been developed over well over a decade of analytical work. And they looked at what the impact of the 25% tariffs that Trump put on, except for energy related products, which is 10%. And they also included the Chinese tariffs at 10% in their analysis, which doesn't show it here, because in their short paper they were just looking at the impact on Mexico and Mexico, United States, and Canada. Although the Chinese tariffs will impact a little bit on the U.S. numbers that are shown here. I think what's really concerning in terms of the tariffs, and this is the bad news, is that manufacturing, which is roughly about 8-9% of Canada's GDP, is very badly hit by the tariffs if they're long-lasting. And this is with retaliation. So it means that what they assume here is that all the countries, or Mexico, China, and Canada put on their own tariffs on a dollar for dollar basis. And as you can see, Canada manufacturing is going to, even with retaliation, is going to lose about 14.2% of the value added in manufacturing. So that's almost, point and half off Canada's GDP. Mexico gets slightly less hit, but obviously is hit very hard. And in the case of services, that won't be affected very much, neither for Canada. Mexico a little more than Canada, but not very much. Agriculture actually is going to drop by 6.7% of their value added under these tariffs as they're in the medium term, if they're in for a number of years. And Mexico, not very much. They did make a comment about mining, which I think includes just all the what's called the mining sector statistically, which is metal mining, quarrying, and minerals and oil and gas. It will fall, actually, they said, by 6.7% the value added in that sector as well, similar to agriculture. They only showed these three on this diagram. And as you can see, United States gets much less affected. They're going to be affected more in agriculture, partly because of the Chinese tariffs and retaliation there. But in the case of manufacturing, they're not going to be affected very much. There is a negative impact, but not that significant, or not as significant for the United States. And the reason for that is that the United States, when you actually look at the total value of imports into the country, which is roughly $2.2 trillion, it's only 7% of their GDP. In the case of Canada, our exports to the United States are almost 19% of GDP. So we're very heavily exposed to the U.S., while the U.S. is not very heavily exposed to us. And it's that asymmetry that really is a very significant problem, because you can see, and this is why the Trump and the people around him don't believe the tariffs are going to have a huge impact on the economy. in the United States because imports are just not that important as part of their overall their sector. And in terms of the effect on total exports, and this gives you an idea of what the impact of retaliation is going to be. In the case of Mexico, without a retaliation, Mexico's exports will drop by 21%. But with retaliation, if they retaliate and other countries, it will be 35%. Same thing with Canada. We'll lose 17% of our exports, which we have to remember our exports are 33% of GDP, so that's a significant fall in terms of our GDP as well. But with retaliation, it's going to make things even worse, 28%. In the case of the United States, their exports are also going to be hurt, 14%, 22% with retaliation. But remember, we're talking about for the U.S. imports being and exports only being roughly 5-7% of GDP. Well, in the case of Canada, we're talking about exports that are in the 30% range and our imports being less, around 25-26% of Canadian GDP. So these numbers are a lot, even though these are significant impacts on exports and imports and trade, overall, as you can see from the value-added calculations, the U.S. doesn't bear as much harm as we will if these tariffs stay in for a very long period. Long, I mean 2-3 years as opposed to 1 year. Now I can go on more about U.S. tariffs. I have a lot to say about the formulation of the, at least the thinking in the United by the Trumpians, as they like to call it, in terms of why they're putting tariffs on for various reasons. And it's not entirely clear which reason is dominating these days. But as you can see, this is actually very serious for us, on top of what was already a weak economy or things not going that well in the first place. The tariffs are even going to have a pretty dramatic and important impact as well. So let me conclude with what I think one of the things we need to think of, besides how we deal with United States on tariffs and for the future, and I won't go into that, but in terms of our economy, we need to get our act together. And I think one of the important questions is, do we think about marginal changes in our policies, or do we think big bang? Big bang in the sense that we really need to do something much more dramatic than we've seen. And it was a problem before the Trump tariffs came along, but now the America First strategy of Donald Trump has made things a lot worse for us. And I think we're going to have to look at very significant policy changes in the future. And big bang changes can have a very important long-run effect. I have been a student looking of Ireland over the number of years. They were the basket case of Europe, 50, 60 years ago. People left Ireland, went elsewhere to North America and to Europe, but they completely reversed that. Now they have lots of people coming into Ireland. Ireland's GDP per capita is highest in the OECD now. If you take away what they pay to the foreigners, because of all the multinationals that have moved into Ireland, their gross national income, which is where you subtract off payments to foreigners and add back income that Irish residents receive from elsewhere, it's still actually much higher than most countries in the OECD, although less than what's measured by GDP per capita. But Ireland had 3 major policies that it did to reverse them, 4 actually. One was to educate their population. Many people didn't even have high school, never mind post-secondary education. That's completely changed in Ireland. Now, in fact, part of it is they started off making tuition free in post-secondary education. Now they charge, but not very high. But this was to get people to become educated, to get their skills. They built up infrastructure. They joined the European Union, but they also took a corporate tax policy of reducing the corporate tax rate to 12.5%, and that attracted a lot of multinational interest in Ireland, and that created a lot of demand for that skilled labor in terms of their overall policy. Israel's also had tremendous success. They had huge number, 25% of their population grew in the early 90s because of the downfall of the Soviet Empire and migration of many scientists and engineers to Israel in that period from Eastern and Central Europe as well. And they undertook a series of reforms, including giving a little bit of money to all these very smart people that came into the country to start up their own businesses. And that was the story behind high-tech Israel. But it was a tremendous success. In fact, since the year 2000, Israel spends more on research and development, it's 6% of their GDP, than any other OECD country, including Korea, which is second highest to Israel. So there are policies that we could do very well. And I'm in my view that if Canada's going to succeed, we're sitting beside the largest market in the world, 25% of GDP. That's what the U.S. represents. There's always a draw to go to the U.S. because of its size. But if we're going to succeed, we have to leverage our resource sector, but we also have to have policies that really are distinctive and tilt the playing field to Canada. And that's been my view that I've argued for almost over 2 decades in terms of what we need to do in terms of policy. And now I think it's even more urgent today. And I think we could use some very significant regulatory reform that everyone talks about. I think we need to have a major tax cut. I think we're going to need to have much more efficient government, much better productivity in government. And just to give you an idea of big bang tax reforms, I think we need big bang reforms in general, like getting goods to Tidewater, increasing our ability to diversify our trade with other parts of the world, etc. But if we are going to do it on the tax side, I think we should seriously think of a major reform to our income tax on the personal side, going to a flatter rate structure, lower rates, and a simplified system. And I won't go into the details, but I actually have a major proposal along those lines. And also a corporate tax where we exempt actually profits that are reinvested in Canada. And get rid of all the other special credits and accelerated depreciation. In fact, you don't need that once you have a zero tax rate on reinvested profits. And in fact, we only tax distributions that are paid out to the firm under the corporate tax. In other words, the corporate tax on distributed profits. I wrote a big paper on that about 2-3 years ago. If any of you are interested in seeing that, but that would be a very dramatic reform that would actually attract a lot of capital to Canada if we did something very significant along those means. And so that kind of finishes what I wanted to say. Maybe I'll stop my share right now, but I'll be very happy to take on any questions that you might have. But let me say this: Canada's gone through all sorts of crises in the past. We've had some very good years as well. We have to remember we've had a depression, we've had world wars that we've participated in, etc. We're in a tough spot right now. But in my view, Canada has great opportunities to take advantage of our significant resources that we have in terms of both our people and our physical resources. And I actually am quite optimistic that if we get our act together, undertake some very significant reforms in the coming years, that actually we will get on track and maintain ourselves as one of the best countries to live in. Anyway, thank you very much.
Thanks very much, Jack. Yeah, grim, but a real positive ending to it. I think that when I talked about the background of this series, and I talked about the conference we had in Toronto in May, there was some important the audience for it, and one of them was the one that Jack mentioned right at the outset. He did this paper with Phil Cross, who's former chief statistician of the Government of Canada, called Canada's Resource Sector Protecting the Golden Goose. was provided to all the attendees of the conference, and it really, a bunch of it reinforced and paid the type of analysis that Jack just showed you in terms of the impact of the Canadian resource sector on productivity, on our wealth and growth. So we'd like to open up for questions. I've got a couple of questions for Jack, but let's go right away to the audience and see if anyone has any.
We're in the midst of kind of a pre-election cycle. Sorry.
Thank you. Thank you very much, Mr. Mintz, for that. That was awesome. And I'm a resource developer myself in the mining, but the question is regarding the pre-election cycle that we're in now. Would the record, Mr. Carney, with all his background, would it indicate that he is capable philosophically of a Big Bang reform? Is he capable of that?
Well, that's a good question. I know Mark. Know him from the years when he was at Department of Finance, particularly, and I can't really answer that question whether he would be able to do Big Bang reform or not. On one side of it, I think he recognizes that some changes are needed, which I think is good. I mean, in the sense that he's talked about the need for reducing spending, although except for capital, which he would expand tremendously, but a lot so far the kind of suggestions I'm hearing from him on a policy perspective are more like what we've heard or we've had under the Trudeau government, such as creating funds that would invest with the private sector in building infrastructure and things like that. And then, of course, he's extremely committed to carbon policies and reducing carbon emissions, and so he'll maintain a carbon tax of some form. I mean, he's going to get rid of the fuel charge, which is some people call a consumer carbon tax, but we have to remember it's really a tax that's paid by smaller emitting firms as well as consumers. Which is the fuel charge. It's like the gasoline tax in that sense, or the diesel tax. But he would, while he would get rid of that, he would increase what's called the industrial one, but it's really the big emitter carbon tax, which would still be there, and then companies could pay for credits from consumers, which is a very complicated thing. But also he has a number of other proposals, like tougher regulations on industrial emissions, as well as bringing in tougher financial regulations that would impact on the financing available for fossil fuel energy companies. So I'm not sure really. I haven't heard things about really opening up LNG exports, opening up trade in energy, and so I'm not sure he'll be offering Big Bang reform. And so I think what we need to do is we need to unleash the private sector, and that's the shackles of regulation, and not just having a tax system where we're doing about the same as other countries, but one in which is unique and really drives investment here, I think, are the kind of Big Bang reforms that I would like to see that would drive the Canadian economy in all sectors, and not just one sector like manufacturing or whatever, but in all, get the pistons going in all the airplane, on the airplane, to have all pistons on and not just one or two. And so I think, I'm not sure I've heard from Mark Carney the kind of Big Bang proposals that I think are needed in terms of getting private sector investment going in this country again.
Thank you, sir. Anybody else?
Yeah, you talked about private sector investment, talked about tax incentives, you talked about investments. What role do you think the federal government, the provincial governments and territories can do now that day-to-day changes, things change day-to-day? Do you think the governments on all levels have an opportunity to invest back into a partnership with private sector, or do you think it should be strictly private sector, or maybe a closer, a collaborative push for that?
Well, I always get a little worried about governments saying they're going to be working with the private sector because they end up politically choosing certain sectors to support, not others. And as I always used to have a quip that the governments often don't know the winners from the losers, but the losers are very good at picking governments. And so I'm not totally convinced that this sort of partnership that people talk about ultimately succeeds, and especially when governments they start providing subsidies and support, they also add a whole bunch of conditions on. So, for example, the last Trudeau budget, or maybe it was in the economic statement in November, they're going to put $15 billion into artificial intelligence data centers that, for pension funds. But, oh, by the way, they can't just use any energy. They can only use green energy to run them, which means that, all the huge data centers that have been announced in Alberta that uses natural gas energy wouldn't qualify for that. And so when you start putting all these conditions on, whether it's certain wages that have to be paid to labor or domestic supply, it reminds me of all the countries that I worked in over the years on tax holidays, where they would give a tax holiday to try to get more investment, but then they load up all these conditions on in order to qualify that they actually didn't succeed that well in driving investment to their countries. So I'm not a fan of that. I'm much a greater fan of the idea of getting rid of the obstacles to private investment, because I think private investors will come, and there's huge ones in the world. They'll come if they can see good profits are to be made. But if they see a system where it takes years to get a project going because of regulation, or because there are relatively high taxes that are not competitive relative to other countries, they'll go elsewhere. And so I think we need to, as I said, we need to be open for business, and I think that's a message that I particularly have for moving along.
You mentioned Ireland as an example of a turnaround and how they implement some major policies. I'm not sure if you can speak to it, how did they get the political will and motivation to actually make those things happen? And can we get that to happen in Canada so we can make the major changes that we need to make?
That's a very good question, and not being Irish, I can't answer that very well. But I think I guess this is sometimes when a crisis happens, but there's a view that things have got to change, and I think maybe we're at that point now in Canada that we really need a significant change in direction from what we've been doing over the past decade, and I think that's often a driving force. In fact, everyone talks about innovation and how we can get more innovation, but as we know, necessity is the mother of innovation, and innovation takes place when people really feel certain changes are made. Which, by the way, one of the big factors that have often led to innovation has been military necessity over the years. There was a wonderful book written on that by a Stanford historian who traced all through the thousands of years of history, and that was one of the factors that led to growth in economies. By the way, using energy was also another major factor that has led to growth in countries as well as urbanization. So I think what the Irish did is they were able to get together and do it. Now, of course, Canada's a different country. We have 10 provinces and 3 territories and our First Nations, and so there's a lot more political barriers to get over in terms of people working together. But also, I think this is why the provinces play a very important part in this, if you want to get moving ahead. And I think if governments feel that there's a real need to move ahead and to improve our position, such as getting more goods out to Tidewater, which means more infrastructure corridors that enable that, a better regulatory system that enables that, then we can accomplish that. And then, as we noticed this past recently, all of a sudden, governments are talking about getting rid of interprovincial barriers, et cetera. And so they're now waking up that that maybe there are some things needed, but we'll see how that continues. That's what worries me the most, is whether that will continue or not.
I think Dr. Mintz for that thought. Your discussion, going more all in on resources though, I guess I have concerns about that in the sense that we're ultimately going to be producing more resources than Canada needs. So we're going to rely on, foreign markets for that. And if anything, the last few months have shown us that maybe foreign markets aren't always going to be there, right? And so, I think of the history of Canada as trying to really push back against that, just being the resource extractors, selling to the Americans and then buying back the manufactured goods, right? That's what we've been pushing back as a nation against for, 150 years. And so the talk of leaning into that more though, I guess just concerns me, especially from the lessons we learned from the pandemic, right? That we do need to have that manufacturing base ourselves so that we aren't reliant on foreign suppliers and all things. So how do we kind of square that circle that, sure, we're really productive in the resource sector, but that puts us in this vulnerable position because we need those foreign markets? Thanks.
Well, first of all, the history of Canada has always been a resource-based economy, and I agree with you that there's always value to being able to harness the manufacturing side that uses those resources to export. And that goes, I think, to the issue of competitiveness. The reason why manufacturing often goes to other countries is because of their actual size of the market. Manufacturing tends to get attracted to large markets and to be there. And so it's not that simple to accomplish that. So I think if we really want to try to build more manufacturing, and it has been done. We've seen countries that don't have big populations, like Ireland is an example. They've actually done quite well in some of their manufacturing sector, as well as country like Japan, et cetera, in the past, and Korea. You have to have a very competitive system to do that, and I think I think that's where the policies have to be to try and do that. My proposal for corporate tax that exempts reinvested profits, I can tell you, would be a huge attraction for investment in all sectors, and maybe we would be able to attract more mining to do that. But if we're not exporting to the rest of the world and we're just trying to have a domestic economy, we'll be poor. We won't do as well. We've always depended on trade, and I think what's alarming right now is the fact that our most important market, the United States, has now become a difficult market. But of course, Trump won't last forever, and so I think we need to think about what we're going to be able to achieve. Now, trade diversification can happen. We could try to export to other parts of the world, but proximity tends to push you to the country that's closest to you. And plus, we have culture, and we also have people that have families that live in the United States as well as Canada. We are a very integrated economy right now with the United States. So we're going to have a difficult position, which is actually what my op-ed is going to be about tomorrow, which is the New World Order. And where do we see our place in this New World Order? Do we try to even hitch ourselves more directly to the United States? Or do we say, okay, goodbye, United States, let's try somewhere else? I'm not quite sure what that is, whether it's China or Europe or whatever. But it's not that simple. And then at the same time, we have to remember that some of our sectors are not that easy in terms of diversification. We can't diversify our oil and gas unless we build pipelines to the shore. And that, of course, will take years, but also a willingness to do that. We can't, in the auto industry, I'm not sure you can diversify the auto. 90% of autos go to the United States and parts. It's not diversified at all in that sense. Can we start exporting cars to Europe and to Asia? That will depend on the big car companies that are all foreign owned. And they would have to say, well, gee, we're better to ship off from Canada than, let's say, Mexico or some other locations that we have to export. And I'm not sure Canada would come out competitively, which goes back to the kind of policies we have in order to encourage manufacturing. So here we have two major industries, oil and gas and the auto sector, which are 33% of our exports to the rest of the world, and they're not diversified. And we can't diversify them unless we have very significant changes. And I don't think in the case of the auto sector we'll ever be able to diversify. It's because it's so integrated in the North American market that I'm not sure we can be competitive unless we had some very significant changes in policy. So it all depends what we're talking about. But I think this goes back to what we do in terms of our public policies. If we want more manufacturing, we're going to have a lot more competitive policies. Otherwise, if you're just throwing subsidies at it, remember, somebody has to pay for those subsidies, and that's going to be taxes on everybody else. And that's not going to help at all.
Dr. Mintz, for your work here today. Sarah Lewis is Senior Manager with Deloitte's Economic Advisory Department. I'm very curious about your comments about how training and education systems can support our economic competitiveness. And nationally, our post-secondary systems being pressured to turn attention to its economic impact, while revenues from international students and government support are shifting. We here in the region have relatively low post-secondary attainment, so similar to some of the examples you've shared today, and a region with a high potential for the development of the natural resource economy. I know you're looking at this question in Alberta, but what do these trends and the attention to tariffs mean for our training and education systems across the country and for our region?
Okay, well, it's just on, as you mentioned, actually, that's in about 8 months' time, I'll be able to give you a very long answer to a lot of those questions, because we're dealing with the post-secondary education system right now in Alberta and funding issues. And it includes everything: universities, colleges, polytechnics, and the whole works. And of course, there are things to be done. Just from a theoretical point of view, first of all, when you're talking about growth, one of the important contributors to growth is human capital. Canada has done well on the education tests that the OECD has, called the PISA tests. We actually rank quite well. In fact, we do very well in that. But what I also worry about is migration and younger people leaving to go elsewhere because they don't feel they have as great opportunities here in Canada and they can do better elsewhere. And I think we have to watch for that, because I think right now we're at a very bad state where we could see younger people moving for that reason. So here we're trying to have a great education system so that they can learn. But if they leave the country after being subsidized to get their education, and I'm not saying take away those subsidies, I'm just saying that's a fact, that we're not getting the best return that we could, from that education if we lose people at the same time. So that's the productivity challenge I think we have in terms of education. But I also think we have to have an education system that trains the people that are needed, by businesses that are locating. And just to give you an example, I just heard this week. Lufthansa is setting up a huge aerospace thing in Calgary. And one of the reasons they're going to Calgary is because there's very good supply of the kind of students they need in order to work in this plant. And so it just shows you how important skilled labor is. Now, of course, if you didn't have the proper training of this and the programs that were being offered by the colleges and polytechnics to do that, particularly the polytechnics, then you wouldn't be able to attract investments like that. So I think we have to watch out for that. The Ontario universities have a very serious challenge with the loss of international students. Not so much. The colleges, some of them are really affected because 50% of their revenues came from, or more came from international students. And so they're going to have to try to make up for that. And so it's going to be a challenge. But I think one of the things, we've had a good post-secondary education system on the whole. I wouldn't say it's been a bad one. I think we've done very well. We have some very good universities, internationally recognized. And so I think we just have to make sure that we get the proper training that is done that the business sector needs. And I think that requires a lot more analysis and incentives that allows businesses, allows a better understanding what happens to graduates in terms of do they go to employers where they're able to go to where they want to work and get the kind of job that they want. And quite surprisingly, a lot of that data is not even collected. And so we're not quite sure really what's happening in terms of skills matching that's absolutely required by businesses. So I think it's something that's I think going to be really important in Ontario. Ontario post-secondary education actually gets less funded as a share of their total revenues, but they have let tuition fees go up more, especially in professionally designated programs. That's not necessarily a bad thing, but I think that's that's why Ontario is facing particularly the international student pressure, because they were trying to make up for government funding by bringing in international students that were paying very high fees. But it became not a training program as much as trying to bring in international students and saying, look, you're going to get Canadian citizenship eventually if you come here, because of the changes that were made in our immigration policy over the past few years, where students could apply for residency after finishing their degree here. So then the universities and colleges went out to many international students and said, here's a good way that you can get into Canada. So it wasn't the education wasn't the objective as much as the immigration objective was. And so I think that's and I think that's one of the things that was unfortunate in terms of what's happened over the past several years.
How's the timing, Joe?
Time for one more?
Time for one more?
This is Craig Husky. I'm a business owner in Thunder Bay. I am very optimistic about this nation, and simply because of all the natural resources we have under our feet, on our land, in our seas and our oceans. However, we've come through a period where there is not a lot of infrastructure been built to be able to handle that. We touched on that this morning. We are really lagging behind on infrastructure to move that product around to give it to world market. That's going to take time. It's not going to happen overnight. It's not going to happen in a few months. It's not some of it. It's not going to happen in a few years. It's going to take some time. What do you see as, let me back up. We are probably very close to a new administration of some sort in Ottawa. What do you see as the most consequential and most important things that new administration will do in the first, say, 60, 90 days of being there to turn this thing around, or start to turn it around in short order, apart from things it's going to take years to do?
Well, I agree with what you said. If we want to diversify trade, it's going to take time. It's not something that's going to be done overnight. Even reducing interprovincial barriers to trade is not going to be done overnight either. And in fact, people forget there's all sorts of ways that governments can bring in barriers that are not trade barriers, but they're non-trade barriers that don't get recognized, like subsidizing certain industries and et cetera, domestically. So, we'll see what happens on the interprovincial trade side. But I think, I think it's still not going to make up for the impact of the tariffs that we're facing right now. So to me, if we look at it from a risk management point of view, and I can go on at length about this, but there are three potential outcomes. First of all, let me just say we have to recognize that the people around Trump and Trump himself have looked at tariffs for three reasons. One reason is to raise revenue. That their view is that a tariff is better to have than raising income tax rates, which are about to take place unless legislation is brought in to to reverse the increases that came in with the Tax Cuts and Jobs Act of 2017. And so but it costs a lot of money doing that. It's going to be close to $4.5 trillion over 10 years to reverse those tax increases. So they want the money, and one of the things they argue is that tariff revenue is better to have and raise than to have these income tax increases. The second reason that's given is to build the industrial heartland. That's the mercantilist argument, that we need to put on a tariff wall to bring back manufacturing. And it's both a national security argument, as the earlier question raised, as well as a jobs argument in the heartland. And it's often referred to by Trump himself as well as people around him. And then the third is to correct issues around trade deficits. And there, the argument is given that the United States provides defense to the Western to the Western alliance, but also, interestingly, they provide a reserve currency, which drives up the value of the U.S. dollar at a cost to the U.S. economy. And the tariffs are really meant, or the various remedies are really meant to deal with chronic trade deficits that arise from the fact of having having a reserve currency. And this is a point made by a 1960s Belgian economist by the name of Griffin, who argued that point. So when you sort of look at those kind of three motivations, you really have three types or two potential things that could happen. Permanent tariffs, which for revenue reasons and to build up the industrial base, which is a mercantilist argument, or short-term tariffs, which is to achieve some remedies that deal with the trade deficit. Recently, I think Trump has gone towards the latter, which is perhaps some good news, in the sense that he now likes reciprocal tariffs, and he doesn't want to have a general tariff, or at least a single uniform tariff across goods, which makes more sense from a revenue and mercantilist type argument. So he's so it may be that there's going to be more of a temporary type situation, if that's with a lot of aggravation, by the way, in terms of dealing with these so-called remedies. So I see kind of like three potential possibilities that will occur. The first one would be let's just wait and be patient and let things run its course, where tariffs that Trump brings in, it causes some fall in the U.S. economy. People get upset. Voters are upset. They put a lot of pressure on Republicans to smarten up, and then the Republicans start withdrawing some of the tariffs, so the government starts relenting on that. And that happened in 2018, 2019, with the Chinese tariffs eventually that were brought in. Although we have to remember that even Biden continued some of them, and even the aluminum and steel tariffs that Trump brought in at that time, Biden continued those, less impact after that as well. So I think that's one scenario. The good part of that is that as we are patient, eventually we'll settle down into a better situation as a result. So that's one scenario that I think is the short run. The second one is we negotiate, and NAFTA 2.2, NAFTA 2 is going to come up anyway for negotiation in 2026, so we started earlier, and we try to deal with some of these issues that the Americans are upset about, things like the digital services tax that we brought in. Supply management may be up for that. There could be some other non-tariff barriers that have been mentioned. For example, we do have regulations that make it difficult to come into certain industries like banking and telecommunications and media. Whether those things will be on the block or not, but again, that would be something to negotiate, but we might be able to offer something back that's important to the U.S., particularly around defense of the North America. We forget, across a certain ocean called the Arctic Ocean is a foe called Russia. And Canada is really vital, I think, to North American defense. But also, I think we have to remember that our resources and energy resources and critical minerals, et cetera, are important to the United States. Lumber, all of that is important to the United States as well. So negotiation, I think, where we can get relief from tariffs, maybe with a kind of a dream of having a stronger North American economy might be something that that can be done in a relatively short period and move things along. The third outcome is we don't get an agreement and tariffs are in for a longer period, which from those numbers that I showed you in those graphs would be very negative in terms of our economy. And to get around that, I think we're going to need a two-pronged strategy, which is trying to build infrastructure, but it's going to take time, as you mentioned, and it's not something that's going to be done in a year or two. It's going to take several years to accomplish things. But I also think that we need to drive our competitiveness of industries so that they can compete at the international level in other countries as well. One thing we have done is we've created trade agreements with Asia and with Europe, which is good. And so there are some alternatives, but it's hard to see anything that's going to be as good as the American market for years to come because the transportation costs are a lot less and it's a huge market. It's 25% of world GDP is sitting just below us. And we already have a lot of infrastructure built for that market. So that's why I'm hoping that I think in the end we'll come to some either negotiation or some relief. And then after Trump, of course, 4 years from now, there could be a new government entirely in the United States and a very, very different approach. But I don't expect a reversal to earlier days. I think we're in a new world today than we have been for some time.
Very much, Jack. Let's give him a round of applause.
Thank you, Jack. Thanks for making the effort to be here, even though you're not here. And happy birthday, because he was going to come here on his birthday, and he missed out on that. So big happy birthday to you, Jack. I hope you have a great celebration tonight. Thank you again.
Good. Thanks very much.
I want to thank Jerry and Stuart both for jumping in kind of at the last minute to rejig our agenda to make this work. Thank you both so much for being here and helping out with that. So big round of applause again for all three. And I know everybody's looking at their watch, so we're going to wrap this up quickly. Again, a thank you to our series sponsor, Intercity Industrial Supply, our event sponsors, Resource Works, Collaborative, Canadian Energy Solutions, Canada Powered by Women, and to the Da Vinci staff for the amazing lunch today. And finally, we have a couple of upcoming events that I want to mention. Our next Shift Young Professionals Network event is happening on March the 20th, so 2 weeks from today. If you have any young professionals in your organization, would love to have them out to this learning and networking event at the Landing. Tickets are only $15 and help your young professionals to grow their networks and their skills. And then finally, mark your calendars for May the 15th. The Chamber is celebrating our 140th anniversary, and that will be our Business Awards Gala in celebration of 140 years of Chamber success. So watch for more details on that. Thank you, everybody, for coming today, and I hope you have a great afternoon.
Get a picture with the mayor.
The mayor, or you when you're meeting at 2, which
For sure.
Okay, smiling. Smiling. Perfect. There's like 30 there for you.
Messing up your day, sorry about that. Everybody was doing. Grab a beer.
Yeah. Go to the next friends, we're not going to. Yeah, anyway, looks like you're busy back now. Sure, okay, change it out.
Great, but that's, you're talking about St. John there, I mean, there's some, I would say, well, they need light oil. You don't need that. So, I'll give you that too.
Okay, you ready? 1, 2, 3. Do a couple waves here. And then another palm. Okay, awesome. Thank you both.
You would want those pictures. Night to Toronto was in well, it's actually my son got it. Like rugby, we're gonna go for Greek rugby between University of Wolves and except he got a concussion 2 weeks ago. 23 days. We want to, my wife and I want to go. Oh yeah, no, that's nothing to that. But the excellence I'm glad they took that. I know he didn't have to be. He played hockey, he's had a good.
Well, that's right. At a certain point, they.
Find another sport.
I'm sorry. Sorry, you have that question, but.
I'm glad, I'm so glad. Yeah, that was.